Here's a question almost no one asks, and it's costing more women in your position real money. Not how should I invest? You've answered that. You have a stock and bond allocation. You have an international component. You have some cash. The allocation is set. The question is, where are you holding each piece of that allocation? Which of your investments are sitting in your 401k or traditional IRA? Which are in your Roth? Which are in your taxable brokerage? Which are in your HSA? If the answer is, I don't know, or more commonly, the same allocation is in every single account, you're paying for a retirement inefficiency that compounds every single year. That inefficiency has a name. It's called asset location. And the research on it is clear. Done right, it can add somewhere between 1/4 and 3/4% to your after-tax returns every year. Compounded over 20 or 30 years of retirement. That's years of additional runway. It's a free raise, and most women leave it on the table because their target date fund or their advisor never asked the question. Hey, welcome back to Align Your Retirement. I'm Hazel Secco, CFP and CDFA, founder of Align Financial Solutions, a fee-only fiduciary firm for women in their 40s and 50s who are serious about getting their retirement right. Your portfolio has a gross return, what the investments actually earn, and a net return, what you get to keep after taxes. The gap between the two is tax drag. Asset allocation is a lever that shrinks the drag. 3 main account types, 3 different tax treatments. Traditional 401k and traditional IRA. But every dollar you pull out in retirement is taxed as ordinary income. The tax hit is 100% deferred until withdrawal. Roth IRA and Roth 401k, every dollar of growth is tax-free forever. Taxable brokerage. Dividends and interest are taxable every year. Capital gains are taxable when you sell. Long-term gains get a preferential rate. Now, layer an investment on top. Imagine a bond fund paying 4% interest in a taxable brokerage account. That interest is taxed as ordinary income every single year. At a 32% federal bracket, almost a third of your bond return disappears to taxes annually. The same bond fund in an IRA, tax deferred. If you hold it in a Roth, the interest compounds tax-free forever. Same bond, 3 different net returns. Now, imagine a broad US stock index fund. That same stock index fund held in a taxable brokerage produces a net return that's very close to its gross return. The tax drag is small. Hold the same stock index fund in a traditional IRA, though, and every dollar that eventually comes out is taxed as ordinary income, not at the preferential long-term capital gains rate. You've just taken a naturally tax-efficient investment and wrapped it in a tax structure that converts its favorable long-term capital gains into ordinary income. This is the core asymmetry. Tax-inefficient investments, things that throw off lots of interest or short-term gains, belong in sheltered accounts. Tax-efficient investments, broad stock index funds, tax-managed funds, individual stocks, held long-term, can live comfortably in a taxable brokerage. Most women with $1.5 million and over are doing the opposite by accident. Traditional 401k and traditional IRA, your tax-deferred accounts. Hold the tax-inefficient investments here. Bonds and bond funds, REITs, actively managed mutual funds, TIPS, high turnover strategies. You're already going to pay ordinary income tax when the money comes out. Might as well shelter the investments that would have been taxed at ordinary income rates anyway. Roth IRA, your tax-free forever account. Hold the highest growth investments here. Small cap equities, emerging market equities, high conviction international equities. Every dollar of growth in the Roth is tax-free forever. Don't hold bonds in the Roth. You're wasting the single best tax structure in the US tax code on a 4% return. Taxable brokerage, the naturally tax-efficient bucket. Hold the tax-efficient investments here. Broad US stocks index funds, ETFs preferred, tax-managed funds. Individual stocks held long-term for capital gains treatment. Municipal bonds, if you're in a high tax bracket, you can also harvest losses, a strategy you cannot use in IRAs and 401ks. HSA, The forgotten superpower, triple tax treatment, if used for qualified medical expenses, hold high growth equity focused investment if it's built to grow, not to spend in the next year or so. For most women in my client base, the HSA is underfunded and sitting in a money market earning essentially nothing. That's a mistake. One specific asset location consideration worth flagging: if you hold highly appreciated company stock inside your 401k, there's a strategy called net unrealized appreciation, NUA, that can let you move that stock into a taxable brokerage and pay long-term capital gains on the appreciation, specific conditions, specific execution window. Once you roll, NUA is gone. Mistake 1, the same allocation in every account. Target date funds do this. Rebalance everything to 60-40 advice does this. It wastes the asset location opportunity entirely. Think of your entire portfolio across all accounts as one portfolio. Set the overall allocation at the level of the whole pie. Then use the 3 account types to hold the right slices. Mistake number 2, holding municipal bonds in an IRA or 401k. Municipal bond interest is federally tax-free. That's the entire point of munis. They have a lower yield than corporate bonds because the yield is tax-free. If you hold munis in an IRA, you get the lower muni yield and pay ordinary income tax when you pull it out. You've simultaneously given up the only advantage of municipal bonds and kept all the downsides. Mistake number 3, not using the HSA as a retirement vehicle. If your HSA sits in cash or a money market earning 1% or less, you're leaving the best tax advantage account type in the code unused. Max the HSA every year. Pay current medical expenses out of pocket if the cash flow allows. Invest the HSA in equities. Let it grow for 15 to 20 years. Here's the quiet thing about asset location. The payoff doesn't show up in year 1. It doesn't show up in year 5. It shows up in year 20 and year 25 when the compounding of that 0.25% or 0.5% improvement has accumulated into a meaningfully larger after-tax portfolio, which is why it gets skipped. It's not exciting, it's not urgent, but retirement is a 30-year project, and the decisions that matter most in a 30-year project are almost never the ones that feel most urgent. Asset location is the kind of decision the 62-year-old version of yourself will look at the results of and think, I'm glad the 55-year-old version of myself spent an afternoon setting this up. If you want me to look at your specific account mix and tell you where the misplacements are, the line call is 15 minutes. You'll leave knowing what to move and why. Link is right next to the assessment. See you there.